Hey traders, Jason here from Levitt Brothers. In this video, I'm going to talk about what I consider to be the most important element of trading. To do this, I'm going to show you some of our trades from January, then I'm going to show you some trades from early February, and then I'm going to show you some trades from middle to late February. And when you see the progression of trades take place, then I'll be able to tie it all together in the second half of this video to essentially explain what I think the absolute key and most important element of trading is. All right, let's get into it. So first, trades from January. So here's Abercrombie & Fitch broke out at broke out here near 22.5, moved up to our first target at 24, moved up to our second target at 27, consolidated, and then moved up even higher after that. BigCommerce broke out from a 2-month base, steadily trended up, several steps forward, one step back, trend never in jeopardy, always staying above its 8 moving average, moved right to its target at 13. Bzoon broke out in late December, trended up to our first target at 6.5, as you can see, consolidated there for a few days, broke out again, moved to our second target, got kind of volatile, but still maintained its uptrend overall. CBay broke out at 6.5, paused here for 5 days, and then continued on to our target at 8. Diamond Offshore broke out late December, pulled back for 2 days on lighter volume. That would stop you out, but then it reversed and headed back up so you can re-enter, and moved straight to our target at 11.5, consolidated for a couple weeks, and then continued up from there. And then FTI, we had this as a breakout at 12.25. It broke out, moved up to its target, pulled back 1 day, and then as you can see, it went past our target and continued on from there. Okay, so these were trades from January. There were dozens and dozens and dozens of them. January was a fantastic month if you like to play breakouts. Stocks were breaking out. They were holding their gains. They were moving up to second targets, third targets. Moves were never really in jeopardy. It was a really good month for people who like to play trends. Now let's get into early February. So here's early February. You have a firm that broke out in late January. It posted a big gain from 14 up to our target at 20, almost 50%. But you can see within a week it gave everything back. AGL broke out, as you can see, just under 21. Within 3 days, it got up to its target. Within 3 days after that, it gave everything back. It moved up again, but then gave everything back. Next up, AMD came out of a base, as you can see here, consolidated, broke out, ran to its target within 2 days, spent a couple weeks going sideways, and then dropped back and gave everything back from the breakout from over here. Big difference between January and February. January, we had stocks that were resting and then breaking out. February, we have stocks moving to the target, resting, and then moving down. Next up, Amazon. You can see Amazon came out of a base here, consolidated, broke out, but then moved up to its target, but then gave everything back. Dutch Brothers broke out in the mid 36, moved to its target, gave everything back, tried to move up again, and then gave everything back plus a lot more after that. Okay, so early February, we had some really good moves, but the gains didn't hold. They didn't move to second or third targets, and in all cases, not in all cases, in all the cases I'm showing you, but not in all cases, gains were given back within a relatively short period of time. So let's move on to later in February. So here you have Beyond Meat, tried to break out there, gave it all back, had one big up day there, and gave all that back, and did not even get close to our target. Now, it got a little bit close. It got more than halfway there, but did not get up to our target. Next up, ACMR broke out, had a couple nice days, gave it all back, didn't even come close to our target. American Eagle broke out, moved up a couple days, gave it all back. It did not come close to our target. ARHS, you can see it attempted to move up right there, immediately fell back into its range, then fell below the bottom of its range. So complete failure right from day one. CRS didn't even break out. Okay, consolidating up here, high and tight pattern. Everything looking good, volume light, all signs point towards higher prices, and it didn't even attempt to break out. One more here, 8x8, moved up, consolidating, everything looking nice, didn't even attempt to break out. Okay, so you can see the difference between January, where stocks would break out, run nicely, consolidate their gains, and then run up to second and third targets. We got into early February, stocks would break out, move to their targets, but then give it all back. And then we get in late February where we just had a lot of failures, and some stocks just didn't even bother breaking out. Okay, which leads me to the point of this entire video. There's no such thing as a good market or a bad market. Okay, there's only a market you are in sync with or out of sync with. There's only a market you are in concert with or not in concert with. January was a fantastic month for some traders and terrible for others. February was a great month for some traders and bad for others. Okay, but it's not the market and it's not you. It's just whether you and the market are on the same page or on different pages. Okay, if you're on the same page, keep going. If you're on different pages, stop. Okay, so stop thinking in terms of this market is great or this market sucks. Instead, think in terms of determining if it's the kind of market you operate best in. Ask yourself, what is the market's nature right now? What is it doing? What is its character and personality? What is it offering? Is my trading style appropriate for the current conditions? More likely than not, traders who fail are using 2021 methods to trade in 2022, or you're using January management techniques in February. Okay, the most important element of trading is to be in sync with the market. You can't use a trending strategy if the market is range bound, and you shouldn't use range bound strategies in trending markets. Okay, note the character of the market and make slight adjustments to be in sync with it. But actually, you're probably only good at one thing, which means you'll either trade aggressively or much less aggressively or not at all. So you aren't actually making slight adjustments. You're alternating between trading a lot and trading very little. Okay, if January was great and February has been frustrating, you're good at trading healthy trends, but not good at trading choppy ranges. This is great. You've learned the environment you operate best in. Now focus on maximizing opportunities during those periods and otherwise do very little. Trading is hard when you force your methodology on the market, but it's not so hard when you clearly define the conditions you operate best in and then commit to only being active during those times. Hope this helps. Be in sync with the market. Don't force yesterday's trading methodology on today if the market has changed. That's where frustration comes. That's where traders end up getting themselves in trouble. All right, we'll see you next time.